Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, heading into today's open. A relief rally surges through futures as tariff threats evaporate, but danger lurks beneath the surface. Will this be a broad market surge at the bell, or is Intel's 13% after-hours collapse a prelude to a tech bloodbath? Second, crisis looms. S&P 500 valuation hits 2002 danger zone, triggering a historic warning signal. The market's safety net has vanished for the first time since the dot-com bust. With tech titans reporting, will blowout earnings justify these nosebleed prices, or is a massive valuation reset imminent? Finally, TikTok shadow war ends. A secret $14 billion algorithm deal rocks the social media landscape. ByteDance is forced to license its secret sauce, creating a new regulated access playbook. Who are the hidden winners as billions in ad dollars are suddenly up for grabs? Watch for a major shake-up in social media stocks at the open. Just when the street was bracing for a trade war, the script flipped. The sell America panic that gripped the market earlier this week has vanished, replaced by a relief rally that is completely reshaping the narrative for 2026. The Nasdaq Composite led the charge, gaining nearly 1% as capital flooded back into mega-cap technology. The S&P 500 and Dow Jones Industrial Average followed suit with modest gains. But do not let the green arrows fool you. This is not a rising tide lifting all boats. It is a calculated, ruthless rotation where investors are picking winners based on earnings quality and punishing those who cannot execute. The breadth is healthy, with 66% of stocks advancing, but the underlying signal is one of caution, not euphoria. The headline story driving this reversal is the de-escalation of President Trump's Greenland tariff threats against Europe. The immediate withdrawal of these threats removed a massive overhang that had forced pension funds to dump US assets earlier this week. However, the deepest story driving valuations is the economic data released this morning. Final fourth quarter GDP clocked in at a robust 4.4%, while PCE inflation held steady at 2.7%. This data combination creates a paradox for equity investors. The economy is simply too strong for the Federal Reserve to cut rates. JPMorgan's chief economist is now explicitly forecasting that the Fed will remain on hold through the entirety of 2026. This fundamentally alters the cost of capital calculation. With the 10-year Treasury yield sitting at 4.26%, the discount rate for future earnings remains elevated. Historically, a yield environment above 4.2% forces a compression in price to earnings ratios for the Nasdaq. This environment typically favors companies with immediate cash flows like financials, which benefit from wider net interest margins over speculative growth. Yet, we are seeing a divergence where high-quality AI names are defying gravity while unprofitable tech gets punished. Nowhere is this divergence more brutal than in the semiconductor space. Intel is facing a reckoning. Despite beating fourth quarter estimates, the stock collapsed over 13% in after-hours trading. The catalyst was catastrophic guidance for the first quarter of 2026, with revenue projected far below seasonal norms due to severe supply constraints. Management admitted they cannot scale advanced node production quickly enough to meet demand. This confirms a structural shift. Intel is failing to capture the AI infrastructure boom. In sharp contrast, this weakness in Intel is fueling optimism for its competitors. TSMC is projecting 30% revenue growth for 2026, effectively capturing the manufacturing demand that Intel's missing. Meanwhile, Meta Platforms surged 5.7% ahead of its earnings next week. Analysts at Jefferies and Bernstein are pointing to Meta's Advantage Plus ad tools generating $60 billion in revenue as proof that AI capital expenditure is finally converting into hard cash. The market is clearly distinguishing between companies merely spending on AI and those actually monetizing it. While equities celebrate, the commodities market is flashing a warning signal. Gold prices are hovering near $4,920 per ounce, testing the psychological $5,000 barrier. Even with geopolitical tensions easing, central banks continue to buy aggressively. This divergence stocks up. Gold up suggests that while immediate tariff fears have subsided, structural concerns about US debt sustainability and currency debasement remain front and center for international allocators. The market has transitioned from macro panic to micro scrutiny. The Goldilocks backdrop of high growth and stable inflation is bullish, but the higher for longer rate reality demands precision. Investors are now looking toward next week's earnings from Meta and the Federal Reserve's January 28th decision to confirm if this relief rally has legs. The easy money based on rate cut hopes is gone. Now, execution is the only metric that matters. Heading into the open, Wall Street is bracing for a collision of forces as a massive wave of big tech earnings slams into high-stakes Federal Reserve drama and simmering geopolitical tensions. The primary focus is a crucial test for the market's AI obsession. About 1/5 of the S&P 500 is set to report quarterly results, including giants like Apple, ticker AAPL, Microsoft, ticker MSFT, Meta Platforms, ticker METR, and Tesla, ticker TSLA. The pressure is immense. The S&P 500 index is currently valued at over 22 times its expected earnings, far above its long-term average of 15.9. Now, get this. This high valuation is happening despite high interest rates, which normally make stocks less attractive. This has pushed a key indicator, the equity risk premium, into negative territory for the first time since 2002. The equity risk premium is the extra return you expect for taking the risk of owning stocks instead of safe government bonds. When it's negative, it means that on paper, risk-free bonds are offering a better yield than the earnings yield of the stock market. This puts enormous pressure on companies to deliver blowout earnings just to justify their current stock prices. At the open, watch if any sign of weakness in these earnings reports leads to an outsized negative reaction as this valuation cushion is gone. This has strategists warning that, quote, the earnings bar had better be met. Investors will be hunting for proof that massive spending on artificial intelligence is finally translating into real profit. Actually, we've reached a show me the money moment for AI. For the past year, the story has been about spending. Goldman Sachs estimates AI-related capital expenditures could exceed $500 billion by 2026. Now, the narrative is shifting from spending to earning. The key here is whether this spending leads to higher profit margins. According to a JPMorgan report, the AI industry needs to generate an astounding $650 billion in annual revenue just to provide a 10% return on that massive investment. So, heading into these earnings calls, listen closely to the cloud computing numbers, especially from Microsoft's Azure and Google's cloud platform, as these are the frontline indicators of AI revenue generation. A failure to show real profit growth from AI could trigger a major valuation reset for these tech leaders, but that's not the whole picture. There's also the drama with the Federal Reserve. The Fed is expected to hold interest rates steady this Wednesday, but the real story is the explosive political pressure on its independence. A while back, we analysed a Justice Department probe into Chair Jerome Powell as a pretext to seize more control over the Fed and flagged the risk that such pressure could paradoxically push the central bank to sound more hawkish to prove its credibility. Today's setup fits that pattern. And as we discussed before, any rebound in goods prices alongside still sticky services, inflation only hardens the case to stay on hold. However, if you zoom out, you'll see another layer of strategy at play where this political pressure could backfire. The common assumption is that pressure from the White House would make the Fed more likely to cut rates, but the opposite might be true. To prove its credibility and independence, the Fed might feel compelled to adopt even more hawkish or anti-inflationary language in its policy statement. This is where the situation takes a more complex turn, because a Fed focused on asserting its independence may be far less willing to cut rates preemptively, even if the economy starts to slow down. So, when the FOMC statement is released, the market will be dissecting every word, not just for clues on rates, but for signs of the Fed pushing back against political influence. Continuing our last discussion, remember Powell's term as chair ends in May, but his governor term runs to 2028. That opens the door to a rare but not unprecedented move to stay on the board, Mariner. Eccles did something similar, and with other governors serving into 2032 and 2036, could create a voting bloc that raises the odds of more dissents and muddier forward guidance. When that happens, even the dot plot can lose credibility, which almost always means more volatility. The meeting follows recent revelations that Fed Chair Jerome Powell faced legal threats from the Trump administration. Powell himself reportedly called the move a pretext to force the dramatic rate cuts the administration wants. This battle over the Fed's autonomy adds a volatile new layer of uncertainty for investors. A few days ago, we also highlighted how prediction markets like Kalshi were pricing roughly a 70% chance that Powell would be out entirely by August. Watch how those odds shift around the statement as a real-time gauge of this risk. On top of all that, you can't forget the geopolitical wildcard. Markets are still on edge after the fallout from President Donald Trump's aggressive push to acquire Greenland, which threatened a new trade war with Europe. While the immediate tariff threats have been walked back, the episode serves as a stark reminder of how quickly a political headline can rattle global markets. Interestingly enough, that episode revealed something called a flash correlation event. Normally, when stocks fall, investors rush into the safety of government bonds, pushing their prices up. But during the Greenland tariff scare, we saw stocks, bonds, and even the US dollar all fall at the same time. The takeaway here is that unpredictable political events can break traditional diversification rules, meaning your safe assets might not be safe at all. This highlights a major vulnerability in the market to sudden, correlated sell-offs driven by political headlines, especially those involving trade. This all sets up a critical moment for stocks. With corporate earnings, central bank politics, and geopolitical threats all in play, the market is navigating a minefield. The results from these tech titans will be the first major test, determining if the market's AI-fueled rally has the earnings power to withstand the pressure. And as you watch these titans report, keep an eye on the broader market. Watch the Invesco S&P 500 Equal Weight ETF, ticker RSP, which gives every company the same importance, unlike the market cap weighted S&P 500 index. A large gap where the tech giants do well, but the rest of the market languishes would signal a narrow and fragile rally. Speaking of how political headlines can rattle global markets, the 5-year-long battle over TikTok has reached a stunning conclusion, creating a new reality for one of the world's most powerful apps. Overnight, a deal was finalized to split TikTok's US operations from its Chinese parent company ByteDance. A new American consortium, including the tech giant Oracle, will now run the show for its 200 million American users. A key detail to understand is that this type of deal is overseen by a powerful but little-known group called CFI-US, the Committee on Foreign Investment in the United States. The fact that CFIUS approved this structure is a major signal in itself. But what really brought this to a head wasn't just about ownership, it's about the secret sauce. ByteDance is licensing its legendary algorithm, the engine that made the app so addictive. In a deal the Trump administration has valued at a staggering $14 billion, ByteDance will now retain just a 19.9% stake in the US business that generates an estimated $10 billion in annual revenue. You see, separating an algorithm isn't simple. This forced localization creates what experts call a geopolitical compliance cost. After all, building and maintaining a separate algorithm and data infrastructure for the US market is incredibly expensive. To give you a sense of scale, ByteDance is reportedly planning to spend around $23 billion on its AI infrastructure in 2026 alone. This massive cost could drag on performance and innovation, a key factor to watch for any company facing similar pressures. As one Forrester principal analyst put it, TikTok's power lies in its content graph. One thing's certain, TikTok in America won't be the same. This sets up a major shockwave for the digital world. For creators and advertisers, the entire game is changing. The situation presents a fascinating duality. On one side, this is an economic decoupling, but on the other, it exposes a cultural decoupling. The global virality that made stars overnight could be a thing of the past. As a new US-only algorithm gets retrained from scratch, that could force brands to completely restructure their spending. Global marketing campaigns will become far less efficient, and advertisers will have to rethink how they reach audiences in a fragmented digital world. At the open, watch for shares of American social media companies and digital advertising platforms, as they may see new opportunities as ad budgets get reallocated. This move is being called a new blueprint for how Chinese tech companies can operate in the West, establishing a new playbook for the ongoing tech rivalry between Washington and Beijing. The core conflict is now clear: market access in exchange for control. This new blueprint is essentially a regulated access framework, a middle ground between completely open markets and an outright ban. It means foreign companies might have to agree to joint ventures, local data storage, and even algorithm reviews to operate in the US. This fundamentally redefines geopolitical risk for global tech investments. So why would Beijing agree to this? Some analysts see this as a strategic concession. It aligns with China's dual circulation economic strategy, which prioritizes domestic economic stability, sometimes even over the global dominance of its consumer tech giants. By de-escalating tech tensions here, Beijing may be seeking stability in other critical areas, like industrial supply chains. Ahead of the bell, the question isn't just about TikTok. It's about which American tech and advertising companies stand to gain from this new fractured landscape. The US government seems to be creating a new framework that distinguishes between different types of tech threats. Consumer-facing platforms like TikTok are being offered a path of regulated access, while hard infrastructure companies like Huawei face total market exclusion. This provides a clearer, though still challenging, roadmap for investors. The risk is now lower for consumer tech, but remains prohibitively high for sectors like 5G, semiconductors, and other critical infrastructure. This deal redefines the rules of engagement, and investors will be watching for the ripple effects across the entire market at today's open.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.